Hi there. Gifting a house to adult children can involve IHT, CGT, and SDLT. Outcomes depend on ownership and circumstances.
Imagine you own a UK investment property and you decide it's time to pass that wealth to the next generation. You sign the deed over to your adult child, completely free of charge. No money changes hands. Yet within 60 days of that generous act, this cash-free transaction will legally obligate you to pay a tax bill exceeding £50,000. Welcome to a technical briefing by my tax accountant. We analyse the complex statutory rules that govern UK property, helping owners avoid the compliance blind spots that routinely destroy family wealth. The problem begins with a failure of translation. To a family, a gift is an emotional act of transfer. To HMRC, a gift is a highly regulated statutory event. This chart shows the logical assumption taxpayers make. Receiving zero cash means zero proceeds, equaling zero tax. HMRC examines this exact transfer through a different lens, then see a market value disposal laden with chargeable consideration and shadowed by GWROB rules. The central error taxpayers make in the 2026-27 tax year is treating a property transfer as a single, isolated action. In reality, signing over a deed simultaneously triggers three completely separate, uncoordinated tax engines. Families routinely optimize this transaction for just one of these pillars, typically inheritance tax, and ignore the other two until the demand letters arrive. Because these three tax regimes operate on entirely different rules, a decision made to protect wealth under one can inadvertently trigger massive immediate cash liabilities under the others. Let's look at exactly how this happens. Consider a 68-year-old parent preparing to gift an investment flat to their adult daughter. The first statutory hurdle they hit is Section 286 of the Taxation of Chargeable Gains Act 1992. This statute legally categorizes an adult as a connected person. Because the recipient is connected, HMRC completely ignores the fact that the property was a gift. For tax purposes, the transaction is treated exactly as if the daughter purchased the flat at its maximum open market value. If the parent had lived in this property exclusively as their primary residence, this wouldn't be an issue. Private residence relief, or PRR, would shield the entire transaction from capital gains tax. But our case study involves an investment property. The parent never lived there, which means zero PRR is available. Every pound of profit is exposed. This chart shows the flat's financial history. The parent purchased it in 2008 for £180,000. By the 2026 gift, it is worth £390,000. The gap between the original purchase price and the current market value creates a chargeable gain of £210,000. Under 2026-27 rules, we deduct the £3,000 annual exempt amount, leaving a net taxable gain of £207,000. Because the parent has other income, they pay the higher rate capital gains tax of 24%. This precise scenario is known as the dry charge. It is a liquidity trap. The parent legally owes HMRC nearly £50,000, but because they gave the asset away, they generated zero cash to pay for it. They must drain their own personal savings to settle the bill, and HMRC does not offer leniency on the timeline. Any disposal of UK residential property falls under the strict 60-day reporting rule. That 60-day clock applies to the payment, not just the paperwork. Missing the deadline by a single day triggers an automatic £100 penalty, with escalating fines for further delays. A frequent compliance failure occurs even when PRR reduces the tax to zero. A nil return must still be actively filed within those 60 days to avoid fines. Under the capital gains tax engine, a generous family transfer instantly becomes a high-pressure drain on the donor's liquid cash. We turn now to the second pillar, inheritance tax. This is usually the catalyst for the transfer. The parent wants to remove this £390,000 asset from their taxable estate before they die. To do this, the property gift is classified as a potentially exempt transfer, or a PET. A PET is essentially a high-stakes 7-year bet on the parent's longevity. If the parent dies within the first 3 years of gifting, the full property value returns to the estate, taxed at up to 40%. Between years 3 and 7, taper relief takes effect, progressively reducing the tax rate to zero at the 7-year mark. A 60-year-old in excellent health has a highly manageable risk profile for this bet. But if a 78-year-old with health complications attempts this transfer, the gift is far more likely to accelerate an IHT crisis rather than prevent one. Beyond the timeline, there is a fatal flaw that frequently destroys do-it-yourself estate planning, Section 102 of the Finance Act 1986. It is incredibly common for a parent to sign a property deed over to their children, but continue living in that property rent-free to conserve their retirement savings. HMRC anticipates this exact maneuver. They deployed the gift-with-reservation of benefit rules. Because the parent retained a benefit by living there, HMRC legally pretends the gift never happened. For IHT purposes, the asset remains permanently inside the estate. There are only two ways to escape the reservation rules. The parent must genuinely move out, or they must pay legally documented full market rent to their children. Paying a token rent will fail. But paying market rent creates an entirely new, unmodeled problem. It instantly establishes a taxable rental income stream for the children, requiring them to declare it on their own tax returns. Attempting to exploit an IHT loophole without fully surrendering the asset results in the worst of all worlds. The family pays the immediate £50,000 capital gains penalty, but fails completely to secure the long-term inheritance tax savings. The final statutory pillar is stamp duty land tax, which governs the acquisition of the asset. There is a dangerous half-truth circulated in property forums. A pure gift triggers 0 SDLT. If a property has no debt attached to it, there is no chargeable consideration, and the tax is indeed 0. However, our case study flat carries a £120,000 outstanding mortgage. By statute, transferring debt is legally identical to transferring cash. When the daughter takes over the mortgage, HMRC dictates she effectively paid £120,000 for the property. Normally, a $120,000 purchase falls inside the standard nil rate band, meaning no tax is due. But the daughter already owns her own home. Owning a primary residence triggers the additional dwelling surcharge. This penalty bypasses the standard tax-free allowance. The 3% tax applies from the first pound of the $120,000 mortgage. The daughter now faces an immediate SDLT bill of £3,600, payable on completion. This trap is geographically volatile. In Wales, the land transaction tax surcharge is 4%. In Scotland, the additional dwelling supplement hits 8%. This is an avoidable liability. If the parent simply cleared the mortgage with other funds before executing the gift, that $3,600 bill would not exist. Gifting a property with debt attached forces the recipient to pay an immediate acquisition tax on a transaction they believed was free. When we step back from the individual statutes, the total wreckage of this single, unmodeled decision becomes clear. The attempt to quietly pass down a £390,000 flat resulted in a dry charge of £49,680 for the parent, a surprise acquisition tax of £3,600 for the daughter, and a lingering 7-year estate risk that requires flawless execution to survive. Attempting to reduce long-term inheritance tax through a casual property gift frequently creates immediate, highly liquid liabilities that eclipse the intended savings entirely. Before you transfer any property deed, the interaction of capital gains, inheritance, and stamp duty must be professionally modeled using your exact financial figures and the current tax year's rules. To protect your family wealth from statutory traps, contact My Tax Accountant for personalized scenario planning. You can reach our team at info@mytaxaccountant.co.uk. Make sure to subscribe to this channel for more technical briefings and tax defense strategies. This video provides general guidance on UK tax rules and should not be considered as professional advice. Individual circumstances differ, and professional advice should be obtained before making financial decisions.